There are 4 key items that you absolutely need to be aware when you're valuing Cardinal Health before you buy the company. And that's exactly what I'm gonna cover in this video. And by covering those 4 items, I'm gonna end up walking you through step by step and proving why this company has an 11% free cash flow yield based on the current valuation. If you add the extra 5% growth that this company is expected to get every year, you have a compelling investment opportunity because that's an average expected return of 16%, which means you can double your money every 5 years. So let's not waste any more time and get right into the video. You're watching More Money, let's get it. What's up everyone? Thanks so much for tuning in. I'm Tay and you're watching the #1 channel on YouTube for people that want to retire early. Now you're watching part 3 of our 3-part series on Cardinal Health. Now let's not waste any time and jump right into that valuation model. Now at first glance of the model that you can download from the description below, some of you might be asking, why am I using a 5-year model for a business that's largely stable? Why can't I just slap a multiple on a normalized annual income forecast? And the answer really is that for any position that I actually own for my portfolio, you'll see me doing this so that I can quickly make adjustments if things change. Like for example, you can see that they divested Cordis, so we had to make an adjustment in the model. We had to reduce the revenues that were associated with that, and of course that would impact the gross profit. So that's why we did it, and that's what ended up happening. Now before we get into the revenue section, let me remind you that the best investment that you can make is by smashing that like button. It really helps YouTube know that this channel provides valuable content, and thus they'll share with more viewers. Okay, let's get right into the revenue forecast. You can see from here that they have 3 revenue streams: pharmaceuticals, medical, and corporate adjustments. Obviously, pharmaceuticals makes up approximately 90% of their revenues and medical makes up the remaining amounts. So let's start with pharmaceuticals. Over the past 6 years, this segment has grown at a CAGR of 9.4%, but as you can see from my model, I'm only growing it out at approximately 5% annually. So why the difference? Why am I growing this out at a rate that's lower than the rate that it's been growing at historically? And the only reason why I'm doing this is because I'm looking to be conservative. I don't have any reasons why pharmaceuticals won't grow at a higher rate, but I'll keep it at approximately 5% and use the remaining as an upside surprise to my valuation. With the medical segment, you can see that over the past 6 years, it has a CAGR growth of approximately 5.9%. And you can see that I'm growing at approximately 3% annually. This is largely for the same reasons why I've reduced the growth in the pharmacy segment. It's really just to remain conservative. If you want to tick that up to 4 or 5%, I wouldn't blame you. So overall, you can see that I'm forecasting revenues to grow at approximately 190 million from 153 million where they were at the end of 2020. And don't forget, 2020 was largely a headwind year for them due to people postponing elective surgeries and a breakdown in the supply chain. So there was more demand than there was supply of medical products. So the point here really is that the back end of 2021 and in 2022, you could have a post-COVID bump here. Now, with respect to expenses, you can see from the model that the major expense that Cardinal Health has is their cost of sales line. This thing runs at approximately 95.5% of their revenues. Now, this is the biggest risk for the company from my perspective. They are a very low margin business, as I dove into and beat to death in the last video. As you can see here, I'm forecasting this out at approximately 95.5% beyond 2022, but you can see in 2021 that I gave them an additional 2 basis points. This is because management guidance is guiding us to approximately $5.9 to $6.05 per share in EPS in 2021. So I adjusted the cost of goods sold line to get us to that EPS amount. All of their other expenses are dumped into that distribution, selling, and G&A line. This I'm forecasting at approximately 3% because this is largely where this has been over the past few years. So when you take all of these expenses into account, you can see that overall I'm forecasting income from operations at approximately 1.5% of revenues. Now this is very low because in normal times, income from operations runs at approximately 2%. So note guys that there's 2 areas that I'm being super conservative when I'm valuing this company out. One is on their revenue growth. You can absolutely tick up the revenue growth in those segments. And the second area is on the expenses. I might be booking in 0.5% too much expenses, but I'd rather be conservative. Now moving into taxes, guys, I hate to break it to you, there's no good answer when forecasting taxes. Every administration changes things, but I'm gonna just run with 21% and readjust it if there's word of anything changing. I do understand that the Biden administration does want to increase corporate tax rates, but I don't know if that's going to actually happen. So we'll see it and adjust as we go. Now in the next 2 sections, we're going to dive into the 2 most important parts, which is their share buybacks and valuation of Cardinal Health. But first, if you received any value from this video thus far, please smash that like button. It really helps YouTube know that this channel provides valuable content. Also, don't miss out on future videos that I'll be making, including a future series on Spotify with a full downloadable model. So in order to not miss out on that video, please consider subscribing to the channel and hitting that notification bell to be notified when I upload that video. And there's only around 12% of you guys who've subscribed to the channel that have hit that notification bell. Guys, it really helps you know when the videos go live. So hit that notification bell. You'll be most up to date when it comes to getting my research. Okay, now let's dive into that share buyback situation. Now you guys will note from the model that I'm not exactly forecasting share buybacks, as the basic number of shares are staying the same. And this is because I'm actually keeping it simple and forecasting the free cash flow per share in each year into the valuation. Management has stated that after their Cordis sale, they're expected to pay down debt by approximately $1.4 billion, which largely gets them to their leverage target. What this means is that it's easy for us to forecast share buybacks in the future because you can either expect them to increase the dividend or make additional share buybacks. I'm largely expecting both, to be honest. So you can see that I'm adding approximately $2 a share to the valuation to demonstrate that approximately $600 million can likely be used to buy back stock from that excess $2 billion that they're getting. Also, right above it, you'll see that I'm adding approximately $12 a share, which reflects the large amount of available cash that the company has on hand to further buyback securities. So guys, of the share price that's reflected in the markets right now, if you really dig behind it, $14 of that is largely just cash on hand. That's a big amount of cash. Now, as I went through in the previous videos, Cardinal Health does have a lawsuit liability. Let's dig into that. They have estimated the liability at approximately $5.7 billion, which they expect to pay out over the next 18 years. You can see here that I've discounted this liability evenly over the next 18 years, and it largely reflects approximately $13 per share. So as you can tell, this largely negates any pickup that we get from the excess cash that the company has on the balance sheet and the extra $600 million coming in post the $1.4 billion pay down subsequent to the Cordis divestiture. So that's not the best news in the world, guys, but what it really shows you is this is why the market is discounting these shares so much. And in fact, I think they're discounting them too much, because even if you take out the cash on the balance sheet and net it with the liability, you still have a business that's worth $85 a share. Now let's jump into the valuation, guys. I'm providing you guys with an EPS valuation and a discounted cash flow valuation. They both get us to approximately $85 a share, so it doesn't matter which one you use, but for Cardinal Health, I prefer the free cash flow per share valuation methodology. This is because it's largely a cash flow return play, and forecasting cash flow is important here. You can see from the valuation that I'm discounting the next 5 years at 5%, and the terminal multiple is generated using a discount rate of 11.5%. I'm forecasting free cash flows at approximately 1.25% of revenues. This, of course, has historically been higher, but let's be conservative and hope for some upside surprise here. So, of course, my valuation is approximately $85, which includes the in and out of the cash on hand netted with the lawsuit liability. I'd like to take an approximate 35% margin of safety on that valuation, so the buy price that I'd like to purchase this company at is approximately around $60 a share. And that's largely where I sold cash secured puts on it to generate an annualized premium of 21%. So if you buy this company at $60 a share, you can largely expect a free cash flow per share yield of approximately 11% for the company, and it's growing that free cash flow at approximately 5% per year for a total annualized expected yield of approximately 16%. So as you can see, the reason why I used a cash secured put opportunity that generated 21% here, as opposed to a free cash flow per share opportunity that's generating approximately 16%, is largely just the spread between the two. I would love to own this and get that 16%, but I love the fact that I can get a guaranteed 21% using the cash secured put. And worst case scenario, if the shares decline, I'm happy to own this at $60. So no matter what, it's a win-win for me. That'll be it for the Cardinal Health video, guys. I'll see you guys later.